This is crazy. I feel like every single week, the stock market is trying to scare investors out of the market. For example, Michael Burry, who's the guy who successfully predicted the 2008 financial crisis, just sold his entire stock portfolio, which is a little weird because he knows things and you're never really supposed to try to time the market. And then last weekend, Jerome Powell, who's the guy in charge of the Federal Reserve Bank, crushed the stock market by telling people bringing inflation down will mean people will lose their jobs. And then this week, a legendary investor by the name of Jeremy Grantham just put out a report saying that we are now in the final phases of what's known as the Superbubble. That sounds terrifying. And by the way, if you're not sure who Jeremy Grantham is, just picture Jeremy Lefebvre and Graham Stephan fusing together Dragon Ball Z style and then training in a hyperbolic time chamber for 100 years to create something of an intellectual Master Roshi. Accurate. And I'm just kidding. But he is very famous for predicting Japan's asset bubble of the 1980s, the dot-com bubble of the late 1990s, and the housing crisis which caused the 2008 financial global meltdown. And now he says we're entering the final phase of the super bubble, which has only ever happened 3 times before in the last century. Once during the Great Crash of 1929, another time between the crash of 1972 and 1974, and the third time, the crash of the dot-com bubble, which is a little bit more mild in comparison to the other two. So here's how he says these super bubbles are formed. During a typical investor lifetime, the stock market does its thing about 85% of the time. In other words, it goes up, it goes down, but on the whole it tends to go up and it works the way it's supposed to. The other 15% of the time, though, is really what defines what happens to the market, because that's when investors make the worst decisions. He says of that 15%, roughly 12% of the time, people cause what's called irrational exuberance. And this just means people are buying and investing in things regardless of what they're worth. And you could argue that we've already been through that phase when people were buying million-dollar NFTs. The other 3% of the time that's left, though, he says, is because of extreme fear. This is what happened to stocks, for example, in 1974, when everyone sold their stocks, which were trading at a PE ratio of roughly 2.5. Now, just for context, today, the stock market trades at a PE ratio of roughly 20, but on average, it should be closer to 15. But you can imagine for the people at that time, when the market fell to 2.5, it felt like the sky was falling and that the stock market was going to go to zero, and that's why people sold. The point is, times of extreme fear and greed are the most dangerous times to be invested in the market, which he says we are now going through, and we're on the cusp of a 2.5 to 3 times sigma event, which means the stock market will crash. If that sounds interesting to the 3 of you still watching this video, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the real bubble, the comment section. Please, YouTube, do something about those bots in the comment section. That is the real bubble and the real threat to the economy. Now, before we get into this video, please understand that this information is not necessarily something you're going to use to predict the market and make millions of dollars with. Instead, it's useful to understand the market in retrospect. But if you understand the information in today's video, it'll help you stay the course so that when scary articles come out that'll make you question your investing strategy, it'll really help you stay the course. And I think that is super valuable. Now, the premise of this paper starts by saying the super bubble pop will drop the market by an insane amount, and here's how it could happen. First, we have the formation of the super bubble itself. And this is usually thanks to interest rates being kept too low for too long, which is when investors get greedy and they buy and invest into overinflated assets at crazy valuations. So phase 1, check, we've already been through that. Phase 2 is called the setback. This is when, thanks to a political or a global event, people realize, wait a minute, maybe the stock market is not going to keep going up forever. They sell and the stock market drops. And sure enough, phase 2 is also something we've already been through. And then there's phase 3. This is when investors get really hopeful that maybe the stock market could recover and break the new all-time high again. And that's when people justify that the economy is doing great, everything is just fine. And here's how it happens. So imagine a stock like Apple. Now, normally, outside of the context of a super bubble, stocks reach new all-time highs extremely slowly because investors are scared to be the first ones to buy the stock at that price. And that's why you see the chart that goes up and down and a little bit up and a little down, and slowly it goes back up. It happens over a longer period of time. But in a super bubble context, stocks can reach new all-time highs extremely quickly, like what what we're seeing now. So you could see Apple reaches the new all-time high of roughly $180. That's when a political or a global event happened which dropped the price down. Now at this level, at $131, the stock looks cheap by comparison to where it was just a few months ago. And that's when the next phase kicks in and investors get very hopeful that it'll probably come back up again. So they buy in, it recovers, not all the way, but then begins the last phase, which is the decline. And these patterns, Jeremy says, keep repeating themselves over and over throughout history right before the super bubble pops. And here's how he says history will repeat itself again. But first, a quick word from today's sponsor. When it comes to the stock market, it's important to understand how well your investments are doing. And that's why I'm so excited about today's sponsor, Moomoo. Moomoo is a free stock trading app, and once you make a brokerage account, you'll be able to trade stocks without paying any commission fees, and they don't accept payment for order flow. Now, when you open the app, Moomoo makes investing easy with their earnings calendar. All you have to do is tap on the Markets tab at the bottom of the app and then click on Earnings Reports. And here you'll see all of the companies that report their earnings for that day. But if you click on this little icon at the top right of the app, you'll see all of the companies that are reporting their earnings for the entire month in a simple, easy to use, intuitive layout. And the best part is that you can even tune into those earnings reports live or even watch them after the fact. I have never seen this before in an app, and I think this is one of the many cool features of Moomoo. But that's not the best part. The best part is that Moomoo is giving away 13 free stocks, and here's how you can get them. If you sign up using my link down below, you'll be able to get 1 free stock. If you complete a deposit of $100 or more, you'll get an additional 9 free stocks, including 3 free exclusive stocks, but only for people that use my link. And number 3, if you complete a deposit of $2,000 or more, you'll get an additional 3 free stocks. Now make sure that after you get those free stocks, that you maintain your average asset balance of at least $100 for 60 days or longer to unlock those free stocks, and make sure that you use this link below to get those 3 free additional stocks. Otherwise, it's only going to be 10, which is still really good. So go download the app, check out their new earnings feature, get the free stocks, and enjoy it. Now let's get back to it. All right, so Jeremy says that today, history looks like it will repeat itself again, and he references all the other super bubble times throughout history to prove his point. And the first time this has happened was when the stock market reached a new all-time high of 543 in August of 1929. After the greed of the Roaring 20s, the market had a setback with a sharp decline down to 358. Now, to the people investing at that time, it looked like a bargain. The stock market was cheap in relation to 543, so the market recovered in a short amount of time of just 5 months. It climbed back up 46% to 433, a 55% recovery of the loss from the peak. But of course, very quickly after, the market fell all the way down to 96, an 82% decline. The second time in history was in 1973, when the stock market recovered roughly 59% of its losses during the summer months before falling back down again. And the third time in history, the Nasdaq, which is this index that follows the tech stocks, went to an all-time high. They had a setback where the market dropped and then recovered 60% of its losses in just a couple months before falling back down again. These are the kind of patterns that Jeremy Grantham says are symbolic of the super bubble pop. And that brings us to today. On August 16th, we've hit what he calls an intraday peak, and we've recovered 58% of our losses from the lows of June. And this means we've sort of set ourselves up to potentially experience another super bubble pop. Now, the argument against this is that the economy looks strong, right? Labor market looks good and people haven't overextended themselves. And he says that's true, but it's also been true throughout other times in history before a super bubble pop. Arguably. And that's because by the time we get our economic data, the reality has changed, because data lags behind reality. And he says the next leg down that will drop the stock market to the next lowest level will be shrinking corporate profits. And when the market realizes this, its PE ratio will drop from the 20 it's at now down to the 15 historical average that it's been, after which point it's anybody's guess how low it will go. But he says before the stock market will go up and has a chance to recover, it really needs to fix a couple things. He breaks these up into short and long-term problems for the stock market to have to face at some point. A short-term problem he names is fertilizer, for example. Russia and Belarus are responsible for 40% of a key ingredient that's used in fertilizer, which is obviously used to grow crops, and that's extremely important to the growth of some markets. And then of course we have the energy shock thanks to the conflict in Ukraine, and that will have an impact on Europe, which could send them into a deep recession, which means global growth will slow down, which will affect the US at some point or another. Another problem he names is the Chinese economy, which he says is on the cusp of collapse. And this is bad because China is the second largest economy in the world, but China's hurting bad thanks to their real estate, which accounts for 30% of their GDP. So whatever ends up hurting China will inevitably have a trickle effect on the rest of the world. And then of course there's the worry of the central bank, which has arguably been one of the biggest reasons why the US economy has grown at the pace that it has. And now Chairman Jerome Papa Powell, aka the Royal Penguin, is pulling out his support. There's also longer term problems for the stock market to have to figure out, like population growth, where, quote, no single country is producing babies at replacement rate except for Israel and Elon Musk. So I've read. But this could have a huge effect on the economy, especially on people like retirees who need a steady supply of younger people to enter the labor market so they could pay into things like social security programs. And then of course there's things like climate change, which could affect the entire world and could put at risk as much as 4% of the global GDP. So it all sounds bad, but is it really? Yes, it is. But does that mean you should sell your house, your stocks, your kidneys, your kids? Well, Jeremy Grantham says to prepare for an epic finale. And that's when HBO Max gave him a call to write for the House of the Dragon, because that is an epic cliffhanger. So here are my personal thoughts. Look, a lot of this makes sense, especially if you consider that tech companies have started laying people off, which you could argue foreshadows what's about to come in the rest of the economy, and all these CEOs that are preparing for a recession and consumer confidence reaching an all-time low. All of these sound like a really good reason to sell. But that's when you should remember this chart, which I like to reference a lot these days. It shows all the times in history that have arguably been great reasons to sell and wait, but in the long term, the market recovered and it didn't make a difference. Now I realize not everyone will have the luxury of time to wait for the market to recover, which is why the most important thing to remember is this. The 67-year-old version of you from today, the person who's getting ready to retire, needs to have assets not only like stocks and real estate and maybe bonds, but also other sources of income like Social Security and maybe a Roth IRA and a 401k and a cash position, so that when the market goes down, you won't have to sell your assets at a loss. And that's why you need to diversify, not just within an asset class, but amongst the asset classes, so you have the option to pick and choose when one is doing well and another one is not. And that's how you defeat this final boss. Now luckily, Jeremy Grantham is not telling people to sell their assets and wait, but he is an asset manager and he might want people to invest with him. Either way, I hope I didn't scare you too much, but this was fun to make sense of. I hope you stay invested and stay awesome. As always, have a wonderful rest of your day. Enjoy your Labor Day weekend. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin with this link right here. Don't forget to move your crypto assets offline in a cold storage wallet. Grab the money while it's still there. Grab your free stocks. Links are all down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.